Now, you guys know I'm all freaking in on real estate, right? However, and I even tell people, one of my pitches to people about co-living and real estate and why they should get involved is that, the traditional vehicles that we were taught to retire by just don't work. They're too slow for my generation, for your generation, for all of us. We're looking for that faster way. How do we rocket fuel our journey to financial freedom? And I truly believe that real estate and co-living is the fastest way in the marketplace today, to get to that goal, to get to financial freedom. However, I like balance. And there are some traditional vehicles that I truly believe complement real estate, not to replace it, but complement. And one of those we're going to talk about with our guest today. His name is Denny Fulk. He is my financial advisor. He is a certified financial planner. He is a father, a friend, and an absolutely amazing, amazing dude. So we're going to nerd out, as he calls it, for the next 45, 50 minutes or so about a strategy called cash value life insurance. Now, this is a strategy I am currently doing myself, actually with Denny. My wife and I have a couple of policies, and we're actually looking to get a few more. Now, I could go into all the benefits of them, but that's what this episode is for. So enjoy it, take notes. And if this is something you're interested in, reach out to Denny. He'll take amazing, amazing care of you. All right. Enjoy this episode. We'll talk soon. So how do you see this strategy? And I am curious what you call this strategy, by the way, because I've heard it called infinite banking. I've heard it called whole life insurance. I know there's a movement away from the whole life insurance term for a while. So I'm curious, okay, what do you call this? And that, this strategy, and how do you see this strategy? Well, let's agree on a term so we can just call it something for people's brains to wrap around. How do you see this strategy complementing, as you say, real estate?
I call it cash value life insurance. And the industry recently changed it to be called accumulated value. But just the word cash value, I think, is a more appropriate phrase because it is a cash equivalent. And that's one of the key differences of like a mindset is it's access to liquidity. And banks are doing this to us. They're taking our cash, right? They're taking our deposits and giving us back, let's just say historically 1%, while they go out to the market and they buy conservative bonds, some equities, and large sums of cash value life insurance, and can safely get 4, 5, 6%, and then give us 1 back, right? So this is where, visually, I'll throw up on a screen, but I think we can also I'll talk through like the math behind this, and we can nerd out as to exactly what we're looking at right here. But cash in and of itself historically has done 1%. So you're
in terms of a return.
Yeah. Over the last 15 years. So it's actually technically done a little less. It's 0.6%.
Okay.
So
get that pulled up.
If we look here in the bottom right quarter, the cash alternative is 0.6, and that's from 2008 to 2001.
Got it.
And so inflation historically is 3%.
Yes.
Right?
And much higher now, right?
Right now it's much higher. And of course, right now you can get about 4 to 5% in a money market or, checking your savings account. That's today.
Okay, so this 1% is a real return.
Yeah, that's the compounded rate of return from 2008 until through last year of 2022.
But I guess what I'm asking is adjusted for inflation?
That's the actual.
That's just actual return. I got you.
Yeah.
Wow.
Yeah.
So you've lost money if you've just held cash in savings accounts, basically, is ultimately what you're saying. Got it.
Yep. Just think about losing 2% every year.
At least.
When it's just chilling in cash, right?
Right.
And so banks take in our dollars, right? And then they're out there getting a nice spread.
Right.
And that's that difference where they're safely using large insurance companies to get 4 and 5% out there, that's not in the equity market. And so, equities will typically, in the long run, get you 8 to 12%. But on any given year, you can lose, 20, 30%. And this is why for especially folks in real estate, they don't want to have their, war chest or just dry powder take a 30% dive when they're right about to go buy a bunch of real estate.
Yeah, I was just going to interject and say this is super popular right now because there's a lot of people in the real estate market specifically that are talking about like, it's not the best time to buy, but we want to hold on to cash. I mean, there's a lot of cash sitting on the sidelines. So if I could just kind of extract what you're saying for the people that are listening, it's like, hey, what you're going to share with us is an alternative and is an alternative way to hold cash and still have it available where you're not losing money every month by 30%, right? So it's a better way to hold cash is kind of how you're promoting this.
Absolutely. Yeah. And there are various flavors of permanent life insurance, right? When you asked about kind of how to frame it, like whole life is kind of like your grandma and grandpa's version, where most people think you have to pay into the policy for your whole life, right?
It's whole life.
Like, it's whole life because you have to pay into it for your whole life.
Gotcha.
But there's a lot of whole life where you can just fund it for 10 years and be done. And it's much like having bought a home on a 10-year note. It's like buying it on a 10-year note, right?
That's a great analogy.
And I think it's important for listeners to know, right, with regard to life insurance, obviously the most important thing for life insurance is the right amount of death benefit at the time of death. And term insurance is super inexpensive and a great way to make sure that like while you're in the accumulation, like building, growing mode, and maybe cash flow is a little tight, buy a bunch of term insurance that can guarantee that if you have a family or if you're planning for a family or you're taking on some debt with all this real estate, that you can cover that really inexpensively with term insurance and terms like renting. And so the way I like to talk about renting term insurance is that buying quality term insurance with a good company. So most mutually held companies like your big guys like Northwestern Mutual, Mass Mutual, New York Life and Guardian, your 4 biggest mutuals have some of the highest performing cash value life insurance for this particular type of strategy. So buying term insurance allows you to basically buy the house of your dreams, like room by room. And what I mean by that, right, let's say you had like $3 million of term insurance that you could transition 250,000 of that into permanent insurance, over the next 5-10 years. And then you've got 2 to 3 million of permanent cash value life insurance, building equity and building more of that fortress for the cash that you can dip into to buy more real estate when it's on sale.
So one of the things I want to dive into before we kind of get into these nuts and bolts is when I first learned about this, it wasn't with you. It was with a different company. They first learned about this cash value life insurance, which you're kind of using interchangeably with permanent life insurance. So, right, you're kind of using those terms a little bit interchangeable. I just want people to understand that because, like, I know for me, being in the real estate world, like we understand houses, not this. Like this is a whole different world, right? And we really have to understand the terms. And so I remember, man, it was so complicated. Like it took me three full 90-minute calls before I was like, what? Like, how does this vehicle work? And I don't know if that was him. I don't know if just maybe it is complicated, but what I'd love to do before we go any further is just in the most simplest, in the most basic terms possible. And I want to go down the road you're talking about, like how it works and the intricacies and the ways that you can play with it and things like that. But I first want people to understand, what is it exactly that we're talking about? And I know that to you that may seem like a simple question, but I remember just it taking me so much to wrap my head around kind of the vehicle itself. So I don't know if there's so my question for you is, what is the simplest way you can explain to someone who probably doesn't know anything about this, what this vehicle is? And then let's continue talking about the benefits and how I use my policies and how I plan to use my policies in the future and those types of things.
So
big task, because it is somewhat of a complicated strategy, right? But
yeah. Well, I think the easiest way that most people get it, especially in the real estate world, is like term insurance is like renting, permanent insurance is like owning. And so cash value life insurance is the most efficient way to own permanent life insurance, to drive the efficiency of building the equity that you would have in your home in a permanent life insurance policy. So again, in term being renting, you rent coverage for 10, 20, 30 years. At the end of term insurance, you have nothing to show for it, right? It's like you've rented a house for 20 years and then you're like, okay, now what do I do? But for life insurance, that's a good thing because you haven't died, right? And that's one of the reasons why insurance companies make so much money, is that term insurance is super profitable. 3% of people die during that term. The other 97%, right, is just pure profit. And whereas permanent life insurance, when you own that asset, you've got the ability to tap into the equity of that home, just like a HELOC. You can pull cash out of these permanent life insurance policies, and you can do it on a tax favored basis. And so more into the weeds, we can get in that later on, but the easiest way to think about it is, right, cool, you can borrow tax free from the equity inside that permanent policy. And at the end of the day, there will still be an asset there in the form of permanent death benefit. It may not be quite as big if you've pulled all the equity out. But that's the easiest way to think about it, is you're owning an asset, you're not renting it. And we're not using this for the permanent death benefit. Almost all of our clients are self-insured at some point. Some get self-insured really quickly. Some, it's the traditional maybe 55 to 65. They're self-insured.
How are you defining self-insured? Just so we're clear on that.
Great question. They've got enough assets where if they died, their family and multiple generations will be just fine with what they're leaving behind. Whether it's real estate, stocks, bonds, a company, they are self-insured, saying, cool, if I don't make it home tonight, my family and generations are still going to be okay. Right. And so that's the way I would frame it.
All right. So let me play this back just so we make sure we got this right. So I buy this thing, and we're calling this thing, this cash value life insurance. I buy this policy, and similar to a payment on a mortgage, where part of that payment goes towards interest and part of that payment goes towards the principal. Similar to that, part of my payment for this thing, this monthly payment called cash value life insurance, is going towards equity, right? Some of it is going towards equity, and you can correct this if you want to adjust how I'm saying it, but like part of it's going towards equity, and then part of it is going towards paying a premium for actual real life insurance, so that if I die, my heirs get X dollar benefit, right? So I am kind of combining these two things, and I pay into that. It's just like a mortgage. I pay every month, and over time, I'm building the equity in this policy. And just like equity in a house, I can go to this, you're with Northwestern Mutual. So I can go to Northwestern Mutual and I can say, hey guys, like I've been paying into this policy for 3 years, and now I want to take a loan against the equity I have. And that loan is easy to get. It's instant. I mean, not instant, but it's quick. It's easy. I can access that cash, and then I can use that cash for whatever I want to use it for. Same as like you're saying, it's like a HELOC. How close am I to kind of how it works?
Yeah, very, very close. You're in it to win it. To your point, like there's the death benefit component. It is a permanent life insurance policy. And so your premiums are going towards purchasing a bit of life insurance. And depending on the size of the policy, right, they could be going towards more life insurance or less. But this is where how structuring and funding the policy correctly makes a very big difference. but that those premium payments that aren't covering the cost of insurance are building equity, and they are accumulating. If we're talking about the strategy that most of our clients like you in real estate have, that equity is not exposed to like the S&P 500. It's not exposed to the market, the ups and downs. There are types of policies like that. But most want to say, I want an asset that is safe. It's my sleep good at night, my cash alternative that can safely grow each year, no matter what the economic environment is. I know that it will grow. And if I need access to it, yes, you can get it quickly. Within 2 or 3 days, the money can be zipped back into your Wells Fargo or Bank of America account, and you can do whatever you want.
And that's a good point too. So it's not just that I'm paying into this equity. It's that equity. So again, I have that payment. Part of it's going towards one thing. Part of that equity is actually growing, and it is growing at a base percentage that is, for all practical purposes, guaranteed. Like unless Northwestern Mutual went bankrupt tomorrow, which is like they have like billions and billions of dollars worth of assets, right? That would be like crazy.
Yeah.
So that's that additional benefit. It's like, I'm not just paying it into it. And almost like a house appreciates, right? So I'm getting appreciation on this asset as well.
Yeah. And actually, I mean, that's one of the unique things about insurance products is that there is an actual guarantee, and all guarantees are only as good as the company that they're backed by.
Yes.
So these policies for mutually held companies, they have a guaranteed column. And then there is the current dividend interest rate column that says, wow, the company being mutually held, when they have profits by law, they have to send those profits back to the owners, which are the policy owners, in the form of dividends. And that's getting a little bit more in the weeds, but it ultimately says, well, yeah, if the company does better than they expected, then on top of the guarantee, there is that dividend interest rate that's being paid. And so this is when, out of all the different companies in the world that you can buy from, there's a handful that are AAA rated by all agencies. And to your point of saying like, hey, if things did get really bad, and we've chatted about this before about the apocalypse type of mentality, is that
there's people out there thinking about that,
right? If the banking system just failed, well, hey, here's another layer, you actually also do have creditor protection from. Every state has a different level of creditor protection, but cash value life insurance is like creditor and predator protected. In case somebody's coming after you, that's cash that can't be touched.
Explain a little bit more about that. Why it's not touchable through a lawsuit is what you're saying, correct?
That's right. So life insurance.
I have $400,000 sitting in this cash value life insurance. I'm still paying into it every month. Someone sues me because they slipped and fell at my real estate property. Like obviously, anybody listening to this should be using LLCs and protecting themselves. But let's just say you get pulled into this. Explain to us a little bit about why or how it's not penetratable through a lawsuit.
Yeah. So life insurance exists to protect families and businesses. First and foremost, the death benefit component. And so that death benefit is tax-free. So there's a handful of tax advantages, and that the IRS and the federal government want for life insurance so that families and businesses can have extra layers of protection. So not only is the death benefit tax-free, that cash value, the equity inside the policies grows on a tax-deferred basis. So it grows without the impact of tax, just like the equity in your home is. But every state has a different level of creditor protection that they allow for. So, I'm sure you got folks listening to this all over the country. You can check your state for that amount of creditor protection, but like the state of North Carolina has cash value creditor protection of $1 million. So that's a nice, that's why a lot of car dealerships, folks in real estate, commercial real estate, and construction will say, oh, great. I know that I've also got $1 million of creditor protection on these dollars.
And just so I'm really clear, that just basically means no one can touch it below $1 million. No one can touch it because that's the state's rule. That's the state's law.
That's right.
So, okay, I think we've done a good job of explaining kind of this vehicle. Like, I think somebody can understand and can get this. And you know, you and I have had this conversation before, but there's a couple of reasons I really like it for people in the space that I'm in, which is obviously real estate, people interested in co-living, people interested in getting great returns. And one of the things I'm seeing with people is that when they have a consistent bill, you know, I'm calling it a bill. Like, let's just say they sign up, they get a cash value life insurance policy, and it comes, you know, that you set it up automatically, comes out of your checking account, right? I don't have to do anything. It's just boom, boom, boom. It's going away. It's disappearing out of my account. And I have to live on what I have made. I have to live on what's left.
Yeah.
And I love this analogy. I think this was in the book Profits. Is it Profits First? What the heck is that name of that book? Profit First. Yeah. And in the book Profit First, he gives this analogy of the toothpaste. And he says, you know, if you go into your bathroom one night and you realize there's like a little bit left in the toothpaste, you know, you usually don't just immediately go grab a new tube. Like, no, what you do, and for whatever reasons, we all do it. We all get into that tube and we roll it up, we squish it. I mean, we work to get the last little bit of toothpaste out of the tube. Even if we're like on our knee and our elbow, he gives this funny analogy and how he explains it. And he's basically like, this is how money works. Like, if you have bills, those bills go out, and then like we always find a way to make it work. We always find a way to live on what's left. Like, we just find a way because it's not there. The money's literally not there. So this is why I call it a forced savings plan. So I have a couple of these policies with you. I think I have 2 or 3. I have 2, 3.
Yeah.
That's a couple of them. And they're just going out every month, right? It's just boom, boom, boom. And so I don't really think about it. I don't really see it. And then I was talking with someone the other day and I was like, wait, he was telling me about these policies. And I was like, wait, I have a couple of those. Like, I literally forgot that I had them, right? And he was like, yeah, you could use that as like the down payment on your next house. And I was like, oh, wow, I should go check and see, you know, how much I have in them or whatever. So I think that that's one of the reasons I like them, is because people in today, it's hard to save. So this is like a forced way to build discipline, if you will. It's just like, it's going out there and it's out there. So I don't know what your perception is of that, but that's one way I explain this to people, is like, just get on this plan and you'll wake up in 5, 7, 8, 10 years and like, oh wow, I've got this saved. I didn't even realize I had it.
Yeah. That's one of the biggest beauties of just forced savings, is that it just it builds a muscle and it builds a mentality that, you know, people say, oh gosh, you know, wow, I forgot that I had X sitting there. Feels really good. It feels nice. And the interesting part is, like, traditionally, like a 401k, right, is when people are working for the 9-to-5 job, they've got a 401k and they might get some match from their employer. So they might get 4 to 6% that's free as long as they contribute to this plan. You can't beat free money. So take that and let it grow for you. But it has this different part in your mind because you can't touch it till you're 60 without all these taxes and penalties. And that's one of the, you know, nice parts about cash value life insurance, is you have access to it. You have access to it along the way, and you can borrow it and replenish it, versus a lot of other accounts. If you pull it out, you can't necessarily put it back in. Adopting that just mentality of paying yourself first,
Yes,
is, you know, almost more than half of like the key to financial well-being in the long run, is pay yourself first and pay your future self first, then pay the bills and all these other things. And if you adopt that philosophy, like you said, humans are really good at figuring things out when it's like a problem right in front of their face that they've got to figure it out. They're not great about thinking about 10, 15, 20 years down the road and planning for that.
well said. I like the pay yourself first is big in the real estate world. I mean, you got to do it.
And it just allows you to build that tolerance. Like Sam, like you said, when you started your first plan, it wasn't, you know, we didn't start that together, but you picked a number that was probably, you know, it made you think a little bit, right, of how much you were stocking away. We always encourage, right, pick a number that's meaningful but doable, and then Yes.
doable long term, like sustainable. Because yeah, exactly.
This is one of the real big issues with cash value life insurance. Unfortunately, we see just in the industry is that it is sold versus explained and positioned in a financial plan. Because if it's oversold, the worst thing you can do is cancel a policy in like the first 5 to 10 years if it's not properly funded and properly structured and all those other things. So use your vision and thoughts about, and this is what you've done such a good job of, Sam, is like thinking forward and saying, great, like here's a number that's meaningful and doable, and I can commit to that, and I'm just committing. And your future self is going to appreciate that. And that's where, for the folks listening, is like, hey, adopt a number that is meaningful and doable, because most clients over time end up having 3, 4, 5, 6 of these things. Because if you think about where your cash flow was 6, 7 years ago versus where it is today, and then 5 years from now, et cetera, you get a much bigger vision for what's possible.
Yeah, well said, man. Another reason I really like it, I jotted down as you were chatting, was and this was how my first policy was explained to me. I'm curious your thoughts on it, but well, actually, before we go into the second reason I really like these policies and the reason I use them, and is there is, and you mentioned this earlier, but I want to kind of explain it in a really fine detail for people to understand. There is a place where these policies can become what they call self-funded. Now, I know you don't recommend that people stop making that payment, but there is I remember this at least. Okay, I'm committing to this payment. It's doable. It's sustainable for a long period of time. But I remember, at least in my head, being like, okay, after 8 years, the interest that you explained earlier, right? I think is how it works. Correct me if I'm wrong, but that interest could eventually pay this premium. Now, it's not going to grow as fast. It might even, could potentially decrease a little bit, but at least it's going to fund until I die. If for some reason after 7 or 8, or, it's a different timeline for every policy, but if for some reason I had to stop that payment, I remember that at least gave me that peace of mind of like, okay, it's not, I'm young. I was in my 20s when I first started. I was like, I'm going to be paying this thing for 80 years. Like, well, sure. Yes, it'll grow. It'll be awesome. You'll be able to use more of it, but I didn't have to. There was that kind of out. Maybe talk about that a little bit so people kind of understand how that self-funding piece works. And again, I know you don't recommend it, but at least how it works.
Yeah, no, it's important to know, the levers you can pull and how much flexibility you have. And some policies have more flexibility than others. And the easiest way to think about it is that the IRS has rules on how much cash you can stuff into a permanent policy based on the amount of death benefit you own. So back in the 80s, when interest rates were in the teens, this rule didn't exist. And people were buying permanent life insurance contracts all over the place. And they would buy like $100,000 death benefit, small death benefit, and throw hundreds of thousands of dollars and get like 15% interest. And the IRS was like, niche, that's too good, right? That's just too good. So they created a rule that said, here's how much cash you can put in. And it's called a modified endowment contract. If you go over that limit, you lose all the tax advantages. So that funding period, though, is a 7-year period. So funded correctly, typically an 8 to 10 year like maximum funding into these plans, the IRS won't let you put any more in. Like if you do, you go over the limit and you lose a lot of the tax advantages, like being able to tap into your cash value tax-free via loan or even just your cost basis. So you don't, I think it's important for folks to know that those options around like, hey, you can borrow and pay back. You don't necessarily have to pay it back. It just depends on a lot of the factors that are going on, like how old you are, how much you get in there, all those things. But you can also just always pull out your cost basis. So whatever you've put into the policy, you can pull that out tax-free at any time with no questions asked. But building a policy out that is flexible, you typically should have like a floor, a minimum funding that the plan might need in those first 5 to 10 years. But the maximum is the one you're trying to aim for. Like fund that as much as you can on the front end, so you take a 30-year mortgage and you turn it into a 10-year mortgage.
Right.
And then you've got the asset there for you that you can tap into along the way. So Every policy's structure is a little different in the flavor that you get. Like universal life insurance or index life insurance or variable, there's a lot of these different flavors. That's why, most clients, when they're look at the broad array of options, to say, you know what, I want the one that I know is going to just grow and not have to worry about as many different bells and whistles. And yeah, you can have eject buttons like, hey, knowing what that floor and ceiling is. Because even if you have a crazy year where, '08 happens and this thing blows up for a little while, as long as you've built up cash value, the cash value can cover the floor. It can cover the minimum premium for a few years or even for a long time.
So you have options in these policies if you have a cash flow crunch in your situation, is what I'm hearing you say. So yeah, and we're going deep on this, which is great. So another reason I really like these policies is that, I remember one of the ways it was explained to me, and keep in mind, when I bought one of these policies, I had never had life insurance before. I was young. Like I said, I was in my mid-20s when I bought my first one. I think I've had it maybe even 22 when I bought my first one, honestly, 22, 23, something like that. It was young. And so I didn't obviously feel the need to have any life insurance at that time. However, the way it was explained to me was like, because there was a piece of me that was like, I'm so young, do I even need the life insurance piece of this? Right. But the way it was explained to me was really great. He said, yeah, but think about this. He said, these policies are guaranteed payouts, right? They are going to pay out when you die, as long as the policy is still active and in effect. And obviously there's ups and downs to this, but, and he said, one of the benefits of having a guaranteed payout policy like this, and again, correct anything I'm saying if it's not accurate, but this is what I remember, is, that it almost gives you this spend all your money while you're alive card. And I know this, I'm just for whatever reason, this was meaningful to me. They said, think about it. If you have kids or whatever, they said, and you're thinking, oh, I want to leave them this, I want to leave them a couple $1 million. I want to do this. I want to do this. As long as you have enough of these policies, they're going to get all that money when you die. So you get to spend your money while you're alive. And I remember just being like, and I'm a live life to the fullest kind of guy anyway. I was just like, that sounds awesome. I don't have to worry about structuring all this stuff. I just need 2 or 3 of these policies per kid, couple for my wife, and we're good. I can literally spend all my money. And if I die with zero, which is kind of if I literally die with zero, then boom, they're going to get this when I pass away. So I'm curious if you would tweak any of that thinking or that thought process, but for whatever reason, it just was it was a cool idea to me. I was like, that's awesome. Because I'm so future thinking that I was setting up all my real estate portfolio for that. And it just gave me freedom to not have to push all things that I wanted to do and things that I wanted to buy and the nice car that I wanted to buy. I have to push all that off to way later. It's no, man, invest in these policies. And it kind of gave that afterlife a little bit of sense of security, at least financially, for those you leave behind.
Absolutely. And it is the green light to spend and enjoy and give all the other things that you have accumulated and built. And it also is an instant estate. You create your death benefit it's a part of your estate. That's for a whole nother podcast around when you get over certain levels and everything else like that. But you can literally today go out and apply for a $5 million, $10 million, depending on your income. Most insurance companies are going to give you, depending on your age, 10 to 20 times what your income is in life insurance.
Wow.
Because think about it. You bought your original one, Sam. I just looked it up, August of 2015. So
about
8 years ago.
So 8 years ago. Let's go.
8 years ago. You're such a stud.
I was 24, older than 24.
Yeah. And I bought my first one when I was 21 because essentially my mentor was just like, hey, stock this away because otherwise you'll do something stupid with it and you'll appreciate it. You know what I mean? But
per point number one I was making about forced savings plans, right?
Yeah.
Right.
Yeah. But that's where I wish I had that explanation, and even that big of a vision when I was that young, and even somebody else share that with me when I was that young too, because it is automatically creating an estate that think of all the dreams and goals that we have for not only just our family, but community and life and those things. And if unfortunately, we get hit by the proverbial beer truck, none of that stuff happens without having already secured that future wealth that you're going to have. So that's when I go back to that, when clients say, when I talk about being self-insured by like 50, 55, 60, many of our clients that are just on a kind of a traditional route, maybe they're an attorney or a physician or working in the bank or whatever, not doing this awesome real estate and co-living stuff that gives them so much more freedom. That the folks that when they are 55, they're self-insured, they don't need it, but they really like it and they want it because they know they're 55 and they're making, $500,000, $1 million, whatever the number is. Like if I kick the bucket today, that's lost income for my community, for my church, for my family, whatever it might be. So it absolutely does. The clients that are in retirement who have these permanent death benefits feel great about spending money. They're trying to spend it down, right? And so it's a great way to think about it as well, as like you've just created a massive estate before you've even really created it.
And correct me if I'm wrong, is the death benefit on these is tax-free to your heirs. Is that correct?
That's right.
Okay.
Yeah.
So it's, regardless of those, like it'll be, I'm assuming if they ever changed the law, they would grandfather these in. That'd be pretty crazy if they didn't, right? But like, at least for now, these things will go to your heirs tax-free. You don't have to worry about doing all of that. And that's big. My wife got an inheritance a few years back and it was like a very steep, it was in the state of Pennsylvania. And in Pennsylvania, like you get taxed, like the state taxes it. They don't let you touch the money until they take their piece. And it was a fairly significant portion of what it was. So yeah, that's great. The third thing I wanted to talk about. Yeah, go ahead.
I was going to say on the receiving end, if you are receiving inheritance, and I don't want to, especially because real estate is phenomenal, but think about like inheriting, if you live here in Charlotte, inheriting, a building in Philadelphia, right? That can be yeah. Would you rather have that or, or do you want just the value in cash in your hand when you're on the receiving end, And that is one of the other pieces, like it's just clean and simple and it's tax-free cash.
Yeah, one of the other reasons I like this is, diversification is a huge topic in the investing world, right? You talk about it. I've heard you talk about it before. Ray Dalio, who's someone I follow a lot. I know a lot of people that follow me, follow him, and he's big hedge fund manager. Talks about diversification. And just my personal philosophy on diversification. I think it was Warren Buffett who said like, put all your eggs in one basket and watch that basket like a hawk. Like that's a Warren Buffett quote, right? So I feel like that's more like my style. I'm like, I believe in this. I know this. I can help control this. I'm going all in on this. And so for me right now, that it's real estate, that's co-living, that's I'm putting my mouth where my beliefs are. And I say that publicly on this podcast because people who know me, I'm teaching, I'm selling courses, I'm doing all this stuff around co-living, right? I'm building, I'm teaching, I'm managing. However, that being said, there is a comfort that I get to have the safety that you've talked about in these policies. And so I feel like for me, it gives me almost more permission to be, and again, it's kind of in line with everything we've been saying already, but like, it just gives me more permission to be more risky, if you will, and go do this cash flow stuff and knowing that I'm building this. And for whatever reason in my brain, it just helps me go out there. And then when I do remember, got these policies, like if whatever happens, if 2008 happens again, like it's cool. I have this, I don't even call it a nest egg. I'm not sure that's the right term for it, but I have this thing, kind of this little engine. Let's call it an engine. It's a second little engine working in the background, building, creating, stashing away. And so, for those people who have kids and have families, and it's like, and I'm even saying that even if I don't die, like if I don't die, I'm not, it's not the death benefit I'm talking about. I'm talking about the equity that you've talked about and the ability to tap into that if absolutely needed to, and, or to invest or whatever. I think that's a valuable mindset for people who maybe are, and a lot of real estate investors, what I've learned, they are on the aggressive side. They're a little bit more on the aggressive side. People who live in real estate are like, they're part of the real estate cult. Like they think real estate's the only way to invest. It's kind of what happens. But it's nice to be able to kind of question that theory and be like, you know what, let me create some safety over here. How would you describe that to people? I mean, does that resonate? Am I saying it correctly? Like, is that...
Yeah, no, 100%. That it, almost everyone has three segments of their financial plan. There's the home run segment, which for you is real estate. For some people, that's running a business or becoming a, partner in a law firm, whatever it might be, or, run a private equity group, something like that, right? That's the home run. And that part is always going to be the very best investment, right? That's the home run. And always, big proponent of investing in yourself first, right? Like that's the deal. But in many cases, like you said, that safe bucket frees up you even just mentally to know that you've got that like backstop. If this other stuff just for some reason crumbled, if something came out of left field and just blindsided you, that you've got this bucket over here that you can use as not only an emergency fund, but like an opportunity fund. And that's the way most of our clients view that cash value, is that it's the opportunity fund. Because if you look at the options, it's like, okay, cash. We already determined earlier in the podcast that you lose 2% every year. If I was like, hey, Sam, I've got this great new, access to liquidity and it loses 2% every year, how much would you give me? Like that. But cash is a necessary evil to be able to be well positioned to buy this stuff on sale when it comes on sale. And so I love, like, you're bringing up Warren Buffett and say like, hey, yeah, they may just know 10 stocks, right? 10 stocks really, really well and buy them at a fair value and then hold on to them and watch them like a hawk. And this is where, cash value life insurance complements real estate so well, is that your two options, if you don't already have a portfolio where you can borrow, from the home equity, and now even right now with where HELOC rates are and stuff like that, that's a pretty rough dynamic, right? That's not if you're just getting going in the real estate world, it is not good to be borrowing a HELOC to go buy another property. Not to say that it's horrible, but it's not as good a math as it was 24 months ago.
Absolutely not. You're exactly right. It's so, prime plus lawn or prime plus a half, and you're at 9%.
You're paying 9%, and that's rough. So the alternative is, okay, cash. We determine that loses you 2%. Then the other is like, okay, equities, and equities typically, are in line with where real estate is. When 08 happened, real estate was just pummeling. When COVID happened, equity market dropped 30% in 30 days. Sent everybody into a tizzy. And even last year, like bonds or fixed income is supposed to be a shock absorber for when the equity market dips. Bonds last year were down over 13% when the S&P 500 was down a little over 18%. So it's that one other asset that's different, and that it's going to actually grow. It's not going to be better than equities, but it sure as heck is going to be better than cash. And in many cases is better than fixed income because it actually is growing without the impact of tax. So bonds over the last 15 years have yielded right around 2.7%, so barely inflation. And some of those bonds are inflationary, right? Or I'm sorry, some of those bonds are taxable. So you're getting taxed on 2.7, you're barely keeping up with inflation.
What's that third bucket, man? You got your home run bucket. That's badass. I like to play in that bucket. you got your safety bucket. What's
the third is aggressive, and that is like equities. That's your 401k, your brokerage account. You could sprinkle in, even doing a little bit of private equity like investments if you have friends or other buddies that are willing to, kind of let you in on those opportunities. But really, like your home run, that's that home run segment. The other aggressive segment, equities. And I'm a big fan of equities in the long run, that traditionally you've been, 8 to 12% compounded rate of return if you're just all in equities. So that's one of the other pieces of like, even if it's somebody that says, well, I always like having $50,000 of cash because it just helps me sleep good at night, knowing that I've got it. Well, great. If you peel off 5,000 a year to integrate this type of strategy, having 45,000, versus 50,000, and realistically, if you funded it correctly, you're probably still going to have like 48,000. There might be a $2,000 delta for 1 year. The next year, you've got that equity in your cash value policy that like you've still got access to more than $50,000 of equity in cash in 2 years.
Yeah, it's an alternative. It's an alternative to holding cash that grows, that has all these other litany of other benefits, and you still have access to it. Like that is the cool piece of this strategy. So as we wrap this up, Denny, what would you, just to kind of put a bow on it, what's your encouragement to somebody who, I want them to be able to, if you could share how they can find you or where they can find out about you more, that I'd like for them to know that, but also just to put a bow on it. What advice would you give to someone kind of like toying with this in their mind and like thinking, okay, well, should I do it? Should I not do it? How would you coach them on that?
Thanks, man. The main thing I would say is, talking to a certified financial planner in your area. I mean, a certified financial planner understands investments, insurance, taxes, human behavior. They understand all the different financial tools, and they will seek to really understand your goals, like what you're trying to accomplish. And in many cases, challenge you to think bigger, hopefully. So that's the first thing, is seeking out a certified financial planner or a CFP. And
I want to interject something. Think bigger and also think long term. It's something you've helped me with. It's just like, not the return I'm getting this year or next year, but like, hey, where are you going to be when you die? Where are you going to be when you die? I mean, it's like that's super valuable. But I just want to interject that. Thank you.
Yeah, I mean, think about the things that actually matter versus what some index is doing or what we think the stock market or whether we're in a recession. Hey, that stuff really actually we don't have any control, and nobody knows. So let's focus on the things we can control. But by having that conversation to truly be able to make a good recommendation with life insurance, whether it's term insurance or permanent insurance or no insurance, like you have to have a good understanding of the whole picture to have clarity in what's on the balance sheet, and then what they plan on having on the balance sheet to be able to make a good suggestion on what someone should do. So that would be my main encouragement for someone, just to seek out a certified financial planner that, if you don't know anybody that you've asked around, and say like, do you love them? Right? Do you love that person? Because life's too short to be like doing business with somebody you don't love, right? And want to spend time with. Our team, we're here in Charlotte. So it's easy to Google DKD Wealth Strategies Group, or Denny Fulk in Charlotte. It's FULK. So there's not a lot of Denny's out there, but there's only one Denny Fulk.
That's awesome. That's awesome, man. Okay, so just Googling you, DKD is your company, and if they Google you, they'll find your contact info.
Yeah, man, we're easy.
Well, man, this has been awesome. Thank you for bringing the fire and bringing the details. And I know that we could have gone like way deeper, but I feel like just reserving that for people to like reach out to you and connect if they want to like dive into, hey, what does a policy for me look like? I think is good, because I think we just talked about, hey, here's kind of the strategy. Here's how I use it. Here's how it complements real estate. And like that's what I wanted people to take away from this session. So thanks for bringing the fire. Thanks for your energy. Thanks for being a friend. And thanks for helping me with my policies and supporting my financial journey. It's been an honor, man. Really appreciate it.
Hey, really appreciate the opportunity, dude, to nerd out together. Make some magic happen. So I'm honored to be on this, and look forward to many more years of making magic happen together.
So what'd you think of that episode? Pretty good, right? Unique. Hopefully that got your brain thinking. Now, I know this episode could have come across as complicated. I know for me, I want simple stuff. And this strategy was a little bit complicated, but I've seen it work. I've talked with enough people. Some of my very wealthy friends are using these types of strategies. And I truly believe that it can be a nice complement to a strategy of investing in real estate. Or if you're really, new to the investing game, it can be a strategy to at least get you saving and get you investing in something so that then you can pull the money out of this policy and use it for real estate one day. So I hope you enjoyed this, and I look forward to our next episode. Don't forget to just subscribe, like, give us a comment. Tell me what you want to hear more of or what you took away from this episode. And if you really want to blow my mind, tell me what you did because of this episode. Did you take some action? Did you share this with a friend? All right. God bless. We'll see you guys soon.